Hi, I'm Max Keiser, and this is the Keiser Report. I'm getting sick and tired of this Barack Obama character. You know, he got an ecological terrorist attack in the Gulf of Mexico, and he's doing basically nothing about it. After a big confab with BP's head honchos, they decided to penalize the company with a whopping $20 billion. Big whoops! Let me explain something to y'all. All that means is that BP gets to expand their credit line by $20 billion down there on Wall Street. To pay for the credit lines, they're going to lower their operating standards, thus increasing the chances of another one of these disasters. So by not actually doing anything punitive to the company, by penalizing the savers, by cutting the dividend, you are engaging in moral hazard and you are rewarding the eco-terrorists. Okay, let's bring in Stacy Herbert to talk about all the news. Stacy, what's happening?
Max, I have apocalypse in the news. I have apocalyptic visions, warnings of Armageddon, and some speaking in tongues. This is what an oil-soaked ocean wave looks like. And this looks pretty apocalyptic, too. Speaking of BP and an act of eco-terrorism, and Barack Obama did describe it as being like 9/11. Well, this is what a wave down in the Gulf of Mexico looks like these days.
Yeah, a sea of oil and blood and guts. This is the Hades right here on planet Earth. Thanks, BP.
And then, speaking of more apocalypse, there is, ongoing wars, multiple wars in the Middle East. And one of the lead advocates and profiteers of this war is leading Christian crusader Eric Prince of Blackwater. Here's a headline: Blackwater owner fleeing to United Arab Emirates? ? According to Jeremy Scahill, it looks like he may be planning on leaving America. The United Arab Emirates has no extradition treaty, and this is one of the theories about why he may be leaving. And he also, Eric Prince, suddenly last week did put up for sale his company Blackwater, now known as Z.
What a ponce. You know, when the going gets tough, the Blackwater execs run away. What a coward. Stay and face your accusers, you warmongering no-goodnik.
And then for real proof that Armageddon is upon us, here is James Cramer.
James Cramer?
The cheerleader of the bubble, of the last few decades. He's been on CNBC telling people to buy, sell, buy, sell, churning everybody.
It's the illegitimate step-cousin of Alan Greenspan.
Well, here he is today.
This market is stupid, and it is hated for a very good reason. The market seems rapacious, arbitrary, capricious, and downright ridiculous, because on days like today, it actually is every one of those things. It's a tale told by an idiot full of sound and fury, signifying nothing. And to mix Shakespearean metaphors, there are too many slings and arrows of outrageous fortune for most of you to feel comfortable owning anything other than a CD.
Well, as we reported on this show, Stacy Herbert, remember that clip, the video clip from last year, James Cramer admitting to using his hedge fund to manipulate prices, to trade on inside information. Now he wonders, a year later, 2 years later, after you've got an entire industry trading on insider information and market manipulation with high-frequency trading, algorithmic trading, program trading, all that stuff that Goldman Sachs and JP Morgan are involved with, which is all illegal, it's highly destabilizing, and it causes market volatility. Suddenly he's, what's going on? Kramer, what's going on is that you destroyed the golden goose of the American economy. Capitalism in America, as we know it, is now dead, thanks to you, your cohort CNBC, and all those shiksas on CNBC who are giving all that fantastic news, which, at the end of the day, means that the economy is finito.
Well, he's speaking in tongues as well, because he's telling people to get out of the markets and get into CDs. Well, this is the opposite of churning. This is exactly a sign of Armageddon coming to the financial markets.
Yes, CDs that pay a whopping 0.00001%, thanks to Ben Bernanke and Alan Greenspan, artificially keeping rates artificially low to help the borrowers and the speculators penalize the workers and the savers. BP shareholders, dividend cut. Hello, savers, you've been completely shellacked.
Well, he's also joined by two other people, one the head of the EU and the other the head of the largest bond fund in the world. First one, El Arian. All it takes is one grain of sand to make the whole system fall apart. This is Mohammed Al Arian, who is one of the heads of PIMCO.
And this is one of those stories where somebody who's got a huge fund is using the size of their fund to threaten politicians, basically, or threaten the world at large.
The next headline reads, EU chief warns, massive government debt will kill democracy and create new dictatorships. This was the EU Commission President Jose Manuel Barroso. And apparently, he set out an apocalyptic vision to John Monks, who's now the head of the European TUC. This is a trade union. And according to John Monks, he said, quote, I had a discussion with Barroso about what can be done for Greece, Spain, Portugal, and the rest. And his message was blunt. Look, if they do not carry out these austerity packages, these countries could virtually disappear in the way that we know them as democracies. They've got no choice. This is it. So here they're trying to force austerity measures onto the workers, and if they don't take it, Barroso, who comes from Portugal, which had a dictatorship up until through the 70s, so he's warning workers, if you don't take these austerity measures, we'll bring back the dictators, we'll get crazy on you again.
Yeah, exactly. That's the key concept to keep in mind here. Workers and savers are being victimized by borrowers and speculators, and when you're a speculator and a borrower, like this guy who's down with the international banking syndicates, they can borrow unlimited amounts of money, billions, hundreds of billions, trillions, to do whatever nasty financial weapons of mass destruction they want to use. And if they make a mistake, they get bailed out, again, at the expense of workers and savers. So it's no lose for them. Workers and savers penalized. They're heading toward debt peonage. They're heading toward neo-feudalism. We're heading toward a new world order where you've got 98% of the world living in abject poverty because nobody is standing up to these speculating bankers, least of which Barack Obama, who's just simply lying down and being run over.
But speaking of this savers versus speculators, apparently the Europeans still have some savings because the next headline, Euro investors eye local property market. This is an article from Australia, whose bubble has yet to burst. Apparently, home prices are up 20% in the last year to March of this year. So, according to the article, European investors are lining up to plow money into Australian mortgage securities as the strength of the local housing market attracts their attention. So because the house prices have risen by 20%, this is drawing in what remains of the savings into which the U.S. subprime bad debts were dumped into European savings accounts and pension funds. And now those same pension fund managers are apparently going to Australia.
Well, I heard they're going to rename Sydney, actually. They're going to call it Bernie Madoffville.
Well, fund manager Jeremy Grantham of U.S.-based investment firm GMO yesterday reiterated his belief that Australia was experiencing a housing bubble. So, again, there are warnings out there that this is a massive bubble. We've had Steve Keen onto our show here on Keiser Report, and he said it's a massive bubble. You look at the numbers, it's a massive bubble. And where do they go when a bubble is about to collapse? They go for all the Ponzi's and chumps that still have some savings, and those are Europeans.
Yeah.
Who are about to have dictatorship, apparently, according to Barroso.
Didn't they see that movie, The Poseidon Adventure? Don't follow that big woman. I forget her name.
Shelley Winters.
Shelley Winters. Don't follow Shelley Winters into Australia real estate property bubble. I'll make a prediction. You're going to lose your shirt.
Well, speaking of losing your shirt, Fannie and Freddie have been delisted from the New York Stock Exchange. Finally, the government is ending the Fannie and Freddie casino as shares will be delisted from NYSE. So they'll no longer be listed. And apparently, remember James Cramer earlier was talking about this, the markets are crazy and rapacious and insane. Up to 20% of market volume has been in these practically penny stocks of Fannie and Freddie.
Fannie Mae and Freddie Mac, they'll go down in history as the biggest laundromat, money laundering scheme in history.
Speaking of laundromats, you do launder money. Dollar primed for collapse by end of June. This is CNBC's Daryl Guppy, and he has this chart here, and he's showing you this parabolic move from 81 to 87 on the dollar index. And as he says, the technical analysis of this is that basically it can only go one way. It'll go straight up, parabolic, and then collapse. And he reckons this will happen by the end of June.
Yeah, I'm bullish on gold. I got so much gold. I don't have a gold toilet like some of these hedge fund managers had. Or I think it was Saddam Hussein had a solid gold toilet bowl. But I've got a lot of gold. I'm bullish on gold.
Well, it's a currency, and cash is king during a...
It makes the transition from being a commodity, like silver sometimes is considered, or copper, or lumber, which is crashing. to being a currency. And as a currency, it's all the way to the promised land, a 1-for-1 ratio with the Dow Jones at $5,000 per ounce. That's my prediction. All right, so Stacy, thanks so much. Gold is really gaining traction in this news environment. Can I offer you a solid ounce of gold bullion?
Well, I'll take the chocolate underneath there.
Okay, well, that makes sense, doesn't it?
Thank you.
And that's going to do it for this portion of the show. Stay tuned. Plenty more coming your way, so don't go away.
Every month, we give you the future. We help you understand how we'll get there and what tomorrow will bring. The best in science and technology from across Russia and around the world. Join us for Technology Update on RT.
Welcome back to the Keiser Report. Here it is, right here. I'm holding it. The Fearful Rise of Markets by John Authors. This is the Rosetta Stone if you want to know what's happened the past few years and what's happening right now. John Authors, of course, is the much celebrated columnist for the FT, and this is the book you've got to get. 200 pages of pure gold. John Authors, welcome to the Keiser Report.
Well, thank you very much for that very kind introduction. Glad to be here.
Okay. Your book starts in March of 2007. Set the scene. Tell us what was it about the Shanghai surprise that made you realize the world's markets were in a, quote, deadly embrace?
Well, what's happened, back then we had what came to be known as the Shanghai surprise. Was a day when the Shanghai Composite Index, which is the biggest domestic stock index in China, dropped 9%. And you then saw a quite remarkable wave of selling across the rest of the world. And here, where I'm in New York, we had a very startling afternoon where the Dow suddenly dropped 200 points in a minute during afternoon trading, caused real panic. It was largely because the computer systems hadn't been able to keep up with all the orders. And that was the first time that you saw a big uptick in volatility after a period when volatility had been historically remarkably low. It never went back down again. That was really the end of, we can say in hindsight, that was the end of what you could call the great moderation for markets. When markets aren't too volatile, then all kinds of financial engineering can work that in normal circumstances wouldn't work. A few days after that, things recovered fairly swiftly from the Shanghai surprise. We didn't get into a full-blown crisis for a good 6 months after that. Part of my job was to help interns, and we had an intern covering the stock market who was wanting to know what the relationship was. What people were saying that the foreign exchange market was very important to the stock market, and why was that? And so you on a Bloomberg screen, it's very easy to get a minute-by-minute chart of what's going on. And I got up a chart of the S&P, which is the main stock market index in the US, and then I got a minute-by-minute chart of what had happened in the exchange rate of the yen against the dollar. And they were basically exactly the same thing. The number of different reasons you would buy or sell an American stock or move in and out of the yen and the dollar during the day, there are myriad different reasons. Over history, there was almost no reason to expect them to move together, and they were moving absolutely tightly in lockstep. As a result of this shock that had been administered to the markets in the Shanghai surprise, you were seeing that a lot of bets that people had made thinking that they were completely distinct bets were in fact all making the same bet many times over in different markets. There was so much leveraged capital behind so many different markets, all of whom were responding in the same way, that you found markets that really should be very different from each other and that are very important. The exchange rate between the yen and the dollar has a great deal of influence on goings-on in trade in the world economy, and so does the valuation of the US stock market. If you see them beginning to move together, that's a very strong sign that they're not being priced efficiently, because they really shouldn't move together. And if prices that important aren't being set efficiently, that's very bad news. That's worrying news, at least, for the capitalist system.
Talk about some of the key events that led to this massive synchronization.
A number of different asset classes used to be completely separate from each other, and became correlated because the governing academic theory of the last few decades has been that to limit risk, what you should do is add extra asset classes that aren't correlated with the asset classes you have, or that might even have a negative correlation. So if, for example, commodities aren't particularly correlated with stocks, and you add them to your portfolio, then the theory is if the stocks go down, there's a decent chance that the commodities won't, and so you'll have less risk for the same rough return. Now, in theory, that's not a bad idea, but the problem is when you look at different asset classes at a time when completely different people were investing in them for different reasons. There's long been a very liquid market in commodities, but traditionally the people who've been playing in that market weren't the people who were also playing in the stock market. Once you have a situation where people in the stock market are also putting money into commodities and are using much the same models and expecting much the same outcomes by doing that, then what you will tend to have is that money will drive returns, and that those two asset classes will become correlated. And you could make similar points about foreign exchange after the various the collapse of various attempts to maintain fixed exchange rates in the 80s and 90s. People began to think of foreign exchange as an asset class in its own right, which is very strange because foreign exchange should be a complete zero-sum game. For any, there's no value created there. For every trade, there should be an equal and opposite winner and loser. But again, people started thinking of foreign exchange as a possible source of return. Traditionally, it had been uncorrelated. Once people start investing in it, or also investing in those other asset classes, and doing so on the basis of the same models, the same assumptions with which they're investing in those other markets, then you will start to see that the correlations emerge. And you could make similar points about the credit market.
Let me get this straight. All the asset classes are different, but all the algorithms that are used to trade them are the same, and at the end of the day, those algorithms are flawed.
The algorithms that decide how to allocate between asset classes aren't exactly the same as each other, but they will tend to have very similar assumptions and to be very similar to each other. And there is one, a lot of those algorithms have worked very well for a long time, but there was the ultimate flaw was the assumption that historical correlations that you've seen in the past could be relied upon to continue in the future, whereas in fact once you rely on those correlations to work, once you actually bet money on those correlations to maintain themselves, it becomes much less likely that they actually will. And that was a basic flaw of the way in which people attempted to manage risks in the last few years. And because not only did they have that flawed way of doing it, but they really leveraged up a lot. They used a lot of borrowed money, which was available because the credit market was so cheap and because centrally set interest rates were so low. Because they leveraged up so much on the basis of their belief that they had a good system of risk management, it meant that the losses were particularly severe, that it was particularly difficult to survive once those bets began to go wrong.
Okay, now using your book as a template for understanding how markets are synchronized and are going to inevitably now lead to these incredible bubbles and bursts. We just got news this past week that European fund managers are driving huge capital into the Australian real estate market because over the past 12 months, they've seen 20% or so gains. Is this going to end in tears, John Authors?
I hadn't heard that one. As I'm not the greatest expert on Australian property, I'm not going to give you a prediction. I do think, however, that property is often one of the first places where bubbles and overvaluations show up. The amount of interest there's been in the Australian dollar has, which very unfortunately for the Australians, has been quite startling in the last few years. It certainly sounds worrying to me, but I'm not going to predict for you that will end in tears. I wouldn't mind owning some Australian property myself sometimes. It's a very pleasant place to live. But certainly 20% in a year sounds worrying.
John Authors, let's move on to the rating agencies. In your book, The Fearful Rise of Markets, you write, quote, Basel II effectively gave the banks and how it contributed to the crisis. Speak on this a little bit.
banking regulations basically allowed the outsourcing of due diligence. Traditionally, one of the big things that banks had to do was to look very carefully at the loans they were making, decide whether the people they were lending to really were going to repay. What you saw with Basel II was that capital requirements were set so that they had strong incentives to invest in particular asset classes, which led them disastrously, as we now know, particularly into US mortgages. And this is true both of banks and of investment managers. Thanks to the way regulations were set, an immense amount of weight was put on the view of the rating agencies. If it was investment grade, you could buy as much as you like, depending on that's true of certain pension funds. For banks, if it's AAA, we can buy as much as we like. Nothing else matters. So what that tended to do was put far too much weight on the opinions of those few rating agencies. Plainly, there were problems with the way the rating agencies worked. The big problem, in my opinion, was the fact that just too much weight was put on that part of the system, and that banks themselves were relieved of the need to think independently and to do their own research. They just relied on, is it investment grade, is it AAA?
Right, and the Basel requirements refer to capital requirements, and of course this is key in determining the debt ratios of the whole system. Now we've got Basel III. Any thoughts on Basel III, the third installment of this?
It's still too early to say. I mean, obviously they're trying to correct the mistakes made in Basel II. The question is whether that will end up being something too backward-looking and will create perverse incentives we haven't seen or haven't thought through yet that will create a different crisis in another few years' time. But I would say it's too early to pass judgment.
Okay, fast forward to today. In your book, you write, quote, the U.S. has too big to fail banks, but Europe has too big to rescue banks. These European banks now look to be in trouble. What do you see happening?
Well, as we speak, Spain, as I understand it, has decided on stress testing its banks, i.e. taking a look at how its exposures would look under certain rather scary scenarios, and to publish those results. I think that will probably put pressure on the countries in the centre of the Eurozone to do something similar. Ultimately, I suspect we're going to see banks being required to behave more conservatively in Europe, similarly to how I imagine we're going to see something like that happening here in the US, where I am now. That would probably lead, I've described it as a Faustian bargain in many ways. It would lead to putting a lid on the kind of upside, on the kind of profits we might hope for, but hopefully it would also reduce the volatility, reduce the risk of a crisis. There will be an immense amount for me and other columnists to write about as these rules get thrashed out, as people look at them. But that is, I suspect, ultimately where we're heading to a financial system that becomes more conservative and more boring and less profitable. So the end, that's where we're headed in terms of preventing these bubbles from collapses from going forward. Improve margin requirements, increase the margin rate, and to maybe cut what appears to be heavy conflict of interest between the rating agencies, the Basel Accords, the Moody's folks, and the investment banks. There has to be somebody's got to be an independent referee in there somewhere. Well, I think you probably need to put the onus back on the banks to actually do their own research. Finally, John authors, what should be done to prevent synchronized bubbles and collapses from happening? And do you see any politician doing anything that might help? Well, there's certainly plenty of things that politicians are talking about that might help. The debate here in the US and in the UK is very much centering on many of the key problems that went wrong with the banking system that we've just been discussing. The area that worries me that I think is also very important and gets much less attention is what you might call the buy side, the investment management industry, the people who actually bought the stuff that pushed up the prices and allowed these bubbles to form. The investment management industry hasn't been around as long as we think. If you go back just to the 1950s, virtually all the stocks that were held on the New York Stock Exchange belonged and being traded by wealthy individuals. Now, virtually all stocks are being traded each day on the NYSE are being traded by institutions. So the typical trader now is somebody who is trading somebody else's money when it used to be somebody who's trading their own money. We all know that people will tend to treat somebody else's money subtly differently from how they'll treat their own. In general, the incentives we put on the investment management industry, the way we pay them, has led to what I call herding. You are paid to maintain your assets, to accumulate assets, and to do that you don't necessarily want to make the big contrarian bets against the rest of the herd. You want to carry on in the middle of the pack, investing where everybody else is doing, because that way you won't be embarrassed by doing so much worse than the rest of them, and that obviously creates bubbles. Now, how we get around that problem, because obviously we do want investment institutions to run our money. We don't all want the hassle of trying to do the investment ourselves. How we get around that is a fascinating problem, and I think it ultimately comes down, like so many other things, to how we pay investment managers. We need to look very carefully at the structure of the industry, the investment management industry that has grown up really only in the last few decades. We need to think carefully about the incentives we give fund managers when we pay them.
All right, the book is called The Fearful Rise of Markets, just out, 200 pages of pure bliss if you really want to know what's been going on the past few years. John Authors, thanks so much for being on the Keiser Report.
Well, thank you.
All right, and I'd like to thank my guests, Stacy Herbert and John Authors, author of The Fearful Rise of Markets. If you'd like to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.